We can also talk about the ability for it would still be taxable, but for the ability of that couple who has an excess in capital to go ahead and start investing in investment properties from that 121.
Welcome to the Real Estate Wealth Generator podcast. I'm Dorian Carter, your host, and today I have Matt Linville with Banker Exchange. So Matt will be talking about 1031 exchanges. We want to talk a little bit about that and go in depth and get some real answers based on what people have reached out to me wanting to know. And certainly I'm not the expert. I stay in my lane. So we got our expert here today. Matt, how you doing today?
Doing well, Dorian. It's a great day and certainly a great day to be on this podcast with you.
Let's talk about this hot item, 1031 exchanges. So if you could tell me a little bit about yourself and we'll start there.
That sounds good. So Dorian, again, my name is Matt Linville. And as you said, I'm with Banker Exchange, LLC. We serve as a qualified intermediary. So our daily choice of business is working with clients who want to complete a 1031 like-kind exchange. My kind of start in this business was back in the mid to late 90s. I worked at the headquarters of the local headquarters of a regional bank that opened up a 1031 like-kind exchange department in the mid 90s. Thankful for that introduction, Dorian, because that has become really the sentinel piece of my work career for the past many, many years. I enjoy it. I love it. I love what an exchange allows for your clients, our clients to do. So that's the sum total of my career, really. And just from the personal side, we are headquartered in Greenville, South Carolina. I have an office in Charlotte, North Carolina. But my wife, Abigail, and I live in the big city of Pilot Mountain, North Carolina, which is about 30 minutes north of Winston-Salem. So I'm on the road a lot. My main job, Dorian, is really to go out, build relationships with commercial brokers, CPAs, attorneys, and then clients themselves, those who are selling these properties, to make sure they understand the rules and regulations of 1031s, how it works, and then make sure that they have an enjoyable and successful exchange experience with us.
I love the work that you do because I get so many questions about it, but what people end up being is kind of afraid because they don't know the rules. So, but if you could just start off for those who don't know anything about 1031s and tell us about it, what is it, and then how does it work?
Yeah, absolutely. So if I could dispel one thing initially, let me just say this. A deferred exchange is not a loophole, and it's not something that we're getting away with per the IRS. So a 1031 like-kind exchange actually has its origins over 100 years ago. Kind of the bones of it was put into the tax structure 101 years ago, as a matter of fact. So it's been around for a long time. And certainly in 1992 is kind of when the industry really took hold with the development of a qualified intermediary like ourselves. So it's been in place. And basically what the IRS tells owners of investment or business property, if you decide to sell your property, you can defer the capital gains tax that you owe and also the depreciation recapture that would be due if upon sale you take those monies and you place those with another investment or business property. Now, there are a lot of rules in between, dates and timeframes, but that is in essence what the IRS is allowing an owner to do. So it is a deferral, not a total exemption of taxes, but upon sale, they get to defer those taxes and basically have more capital to put into a replacement property or a better opportunity to leverage up and buy up on the replacement side.
Yeah, that's huge. And I'm glad you pointed that out. People sometimes call it a loophole or may have understand it as thinking it is one, and it's actually not. Tell us some common use situations for 1031 ones, because I get that question a lot. Well, where can I use it?
Basically, Dorian, I mean, the 1031, it's not the property of the rich. It's not the property of the wealthy. It's a benefit to anyone, from someone who owns a single family rental property, owns a lot of land, or yeah, a national company selling property as well. But basically, when you're selling that piece of property, the benefit comes from the deferral piece. So if you're deferring 15 to 20% of your capital gains tax due on sale of that property, if you're able to defer up to the 25% requirement of the depreciation recapture kind of pullback from the IRS, potential state tax and investment tax as well, that's really the great benefit. We have small business owners, we have farmers, we have conservation groups, we have, again, your multinational retailers all taking advantage of this tax deferral, which allows them, again, to buy up or diversify, something you and I've talked about, Dorian. If I own one large property and I want to diversify out into other markets or into other asset classes of properties, 1031 allows me to do that, again, all while deferring those capital gains taxes that I may have owed on sale.
I'm glad you said one thing that is not a tool for the rich. I can attest, I have many come to me that would be first time users. Matter of fact, I have one, and of course we've discussed that individual about, and this is their first time, and they're not wealthy, but they understand that based on the tool itself, they can utilize it right now to acquire a property and defer some of those taxes. And the big part of what you said is the recapture rate, which is a separate tax that the IRS gets when you've took too much money from them, right. And when you sell it, they want to get it back. That's why it's called recapture. They're coming to recapture. But that part too is an additional part that put in there when you have a 1031, and certainly it is a benefit. And so right now we have a lot of people that are cashing out on their primary homes and selling and making big money, or coming out of the deal with big money above the allowance of whatever it is for single and then married couples that separates that capital gain amount, but they're coming out above what the allowance of IRS is. Tell us a little bit about how people can use that from a primary home.
So a primary residence does not qualify for a 1031. Like you're saying, Section 121 allows a single to take up to $250,000 exclusion, a couple up to $500,000 exclusion when they sell their primary residence. Now, I can tell you that there are situations where someone had a primary residence and they lived in it the past 2 out of 5 years, and then they've turned that property into an investment property over the last two. They've rented it out, right? So that happens a lot. And there is an actual ability to tie in both Section 121 for the deferral up to 250 or 500,000, and those excess monies, wrap that up in a 1031 and use that as an exchange into investment property. Now, those situations can be rare, but they certainly do happen. Now, we can also talk about the ability for it would still be taxable, but for the ability of that couple who has an excess in capital to go ahead and start investing in investment properties from that 121, and then be able to take effect of Section 1031 whenever they decide to sell that property at a later date. So even if they might not be able to experience 1031 benefit off the sale of the primary residence, it can happen if they've used it as investment the last couple of years, or if they decide to use that cash toward an investment property, sell it at a later point, and then exchange and roll those monies over.
Yeah, it definitely makes sense. So what we're seeing now, and the reason why I wanted to bring that up is that specific situation, and the fact that people not move years ago and have several homes that they were leasing out, and the market is so good now until they are selling off their investment properties and taking advantage of that. We see that happening now as well. So absolutely. That's really important, because I think the law itself can be used by a lot of people that aren't taking advantage of it. And so it's important to get the the word out so Banker Exchange, of course, can be doing your 1031, right?
That's right. Absolutely.
Yeah. So let's go a little bit more into the capital gains side and kind of the rules as far as, okay, I got $200,000 that is at risk of the capital gains tax towards it, meaning we got to write a check at closing at IRS unless we've contacted Matt. So give us the rules, because I heard a birdie told me that it was too late once closing has happened to take advantage of 1031 exchange.
That's right. That bird told you right, Dorian. So yeah, one of the things we want to make sure people understand on the 1031, what's required by the IRS, is that you as the client cannot have constructive receipt of those monies, which means when you go to closing and you've closed and you have access to that money, the IRS says you're in constructive receipt, and a 1031 no longer qualify for that. So the most important first step is that they contact a qualified intermediary and they have an exchange agreement in place before they close. Now, what's that look like? It's a simple form that they fill out that gives the qualified intermediary all the information on the property they're closing, who's closing it, address of the property, the contract, things that they already have in hand. And that qualified intermediary will write the exchange agreement, enter into that agreement with the client, work with the client's closing agent to make sure that they know how much money's leaving the closing agent's escrow account and coming directly to the qualified intermediary. As we say, don't pass go, don't pass through the client, come directly to us. And if those things are done, then yes, they have started their exchange. Okay, so let's say you have a client selling for $1 million, okay? And let's just give the easy example. They have $500,000 worth of debt in that transaction. They go to closing, they close, they pay off the debt that's tied to that property at closing. So they have $500,000 minus some closing fees and expenses. That comes directly to the qualified intermediary. We've set up a separate account just for them to hold those proceeds, okay? Now, I know we're going to talk about it, but let's go ahead and do it. So there are two clocks that begin to tick as soon as they close on this property, which is called their relinquished property. There's a 45-day clock and a 180-day clock, okay? And I hear a lot of different versions of these time frames and numbers and days, but let me just assure you, 45 days is the amount of time that the client has to identify potential replacement property. Okay, so the most frequently used rule is the 3 property rule. And they say, listen, you can identify any 3 properties as long as those properties would be held for investment or business purposes. And you can close on any or all of those properties to complete your exchange. But you have 45 days in writing to give those identified properties to us as qualified intermediary, okay? During those 45 days, Dorian, knowing that properties may fall off that list or they may not be able to get a contract on that property, they can amend that identification at any point and as many times as they want to until midnight of the 45th day. And then it's set in stone, okay? Now, the second clock that began to tick is the 180-day clock. So they have 180 days from the time that they sold their property to actually close and take title to any or all of the properties that they identified, okay? So it is a tight time frame. Those 45 days and 180 days, that includes weekends, holidays, birthdays, rainy days where we don't want to get out and look at property. It's just straight calendar days. So that time frame can be daunting. It can be a little intimidating, but with some advanced planning, with talking to your commercial broker like yourself, Dorian, working with a broker who understands the time frames, working with a bank or whoever it is your kind of debt partner may be, that they understand how tight time frames can be. 1031 can work very smoothly, but again, 6 months to complete everything that's needed.
Yeah, that's very, very important because most contracts around real estate end up being business days.
Mhm.
And so you have to have someone that's always watching the clock, literally, because with the IRS, it means calendar days. There is no break. And it just makes sense, right? Because they don't
Yeah.
give you breaks on when they want their money. They don't care. The date is the date, except maybe, sometimes they give you a couple for filing, right? Like this
Right,
was the
sure.
18th. But other than that, you still, oh, thank you for that.
Mhm.
So here's the thing is, what are some of the common mistakes that you see people get into? And I'm sure the time is one of them, but what are some of the common mistakes that causes people to really get bit by the ultimate bug? And that means
Yeah.
that they got to pay IRS.
I would say, Dorian, most common mistake is not having an exchange agreement in place before they close. We get a lot of calls from the closing table, and if they haven't closed yet, we can get an exchange agreement to them. But if they've already closed, then we can't help them on that piece, no matter how much we would like to. I think the second piece is trying to get the full deferral of the taxes owed. And let me go back to the $1 million example. What the IRS says at the end of the day is if you sold a property for $1 million, they want you to buy a replacement property for at least $1 million for a full deferral. They want you to be in the same position at the end of the day as you were at the beginning of the day.
Mhm.
So in our example, $1 million, $500,000 worth of debt, they want to make sure that you use all of the $500,000 in equity towards the new property. And since there was debt on the property you sold, they also want you to get an equal amount of debt on the replacement property to bring you up to that $1 million. Anything that the client walks away with at closing is potentially taxable, and everything that they put into the exchange and use towards the purchase of that replacement property is potentially deferred. So there are instances where we have clients who buy a lower cost property, and they realize that whatever they walk away with or whatever boot they receive in the deal, they'll be taxed on. The good thing about the 1031, it's not an all or nothing. So you can walk away with some cash, or you can put it all in. You can take a partial deferral or a full deferral, either way. But we always make sure that they understand whatever they walk away with is taxable. So we'll make sure they don't walk away with too much money. I think the third thing, Dorian, I would say, especially in today's market, is there's a need to plan. Go ahead and go out and look at properties now so that you have an idea of what you want to identify. And matter of fact, you can go ahead and get a contract on a replacement property as long as you don't close on it, but you can go ahead and lock up a property if the seller is willing to do that, and keep it in place until you sell yours, and then roll into that as your replacement property. So little tips on some pre-planning would help avoid a lot of mistakes. Mm-hmm. And finally, I'll say this, Dorian, as a qualified intermediary, we cannot be a tax advisor for the client.
Yeah.
So I think one of the other things, I won't say it's a mistake, but it's really helpful, is for our clients to have a good tax or legal advisor they can work with when it comes to these 1031s, especially on the CPA accountant side. So they know exactly how much tax they are deferring, what their basis is going to be, and what the tax implication might be if they decide to walk away with a bit of cash. So we always advise working with their tax professional.
Yeah, and I'll double down on that. As a licensed broker in a few states, this is not meant to be as financial advice. You absolutely have to reach out and work with a qualified CPA that specifically has experience around commercial real estate. I would tell you that there is a difference. Yes. And being a CPA is different than being an accountant, because there are certain rules that I only work with certain commercial CPAs and accountants, and make sure they're around before the transaction even get down the road. And so you said very valuable information. because unfortunately, you see a lot of this happen where it's just the lack of planning, right? And so
Yeah.
hopefully you're working with professionals that remind you of that. So we're close to the end, but here's the other thing that I'm always concerned. I don't get too political. I like to work on both sides, but I'm
Right.
always concerned about anything that affects my capitalistic abilities to operate in business in the U.S. And so I'll say that as it is. Government limits on 1031. You know, there's politicians circling the wagon, I would say, looking for opportunities. What is your thoughts and what have you heard around government modifications of the 1031 law?
Sure. So 1031s have been on the chopping block for years and years, Dorian. It's a real popular piece of tax code to go after. However, they really haven't been too successful in changing very much. Matter of fact, really until and again, I'm apolitical on this discussion, Dorian. It wasn't until the Trump administration when we actually almost lost 1031s altogether. Matter of fact, under the Trump administration, which typically people think of a Republican administration as very, very business friendly, we actually lost the ability to exchange personal property. So for all those clients we worked on with aircraft, with cattle, with fleet vehicles, or the personal property portions of those buildings that they were selling, that was done away with. So now we only have real property in the 1031. So then last year under the current administration, part of the funding for the family plan, they looked at limiting or capping the capital gains deferral amount in 1031s to $500,000 for a single to $1 million for a couple. That was highly debated. The Senate, the very last voice vote in the Senate by Senator Kennedy from Louisiana said, please leave 1031s alone. Standing ovation from the crowd. Of course, that was at 2 a.m. at the end of the bill, and I think everybody wanted to go home. Yeah. So the Senate really doesn't have a lot to say, but it went to the Congress and it went into committee, and the recommendation to change 1031s was left out of the House Ways and Means Committee recommendation. So 1031s were left out of the bill, which wasn't passed anyway. Now we have a revival just a couple of weeks ago for the 2023 tax plan. There's going to be another push to cap the deferral amounts on 1031s. We don't think it will be successful. Folks from both sides of the aisle see the benefit of 1031 and the business driver that it is for our economy, and the fact that 1031s bring more tax dollars to the table than the amount they would gain by capping the deferral amounts. Yeah. It doesn't make a lot of sense, but it's a great talking point, okay, for those who like to bring that up in front of the media and such. But we really don't think it will change. If it does, honestly, Dorian, if it's $1 million cap, a lot of the clients we work with will still be able to complete their exchange. And there are wonderful, smart, legal, ethical tax attorneys out there who are finding the ways to diversify their clients' portfolio so that when they do sell individual pieces, they'll be able to stay underneath those caps, or at least as much as possible. So we don't want any change. It's a slippery slope. Once they begin to change things, they tend not to stop. So we don't want any changes at all. And we feel pretty confident that nothing will change.
What you said was very key, especially about the part that when things do change, there is always a subsequent way that a solution or a workaround will occur. It doesn't mean don't fight for something, but it certainly means to have, as we spoke earlier, a great professional that understands real property, commercial real estate, and how to go another path in gaining the advantage, especially around paying your fair share. I still call it paying your fair share of taxes, but only my fair share after I've utilize everything I can take advantage of. So
That's right. That's right.
So, well, great. If Matt, please tell us about your company, Banker Exchange. I know you started out, but tell us a little bit more about Banker Exchange, and then also how we can get a hold of you for help around 1031 or just have any questions.
Yeah. So again, Banker Exchange, Qualified Intermediary, headquartered in Greenville, South Carolina, but we work in all 50 states. We have served as Qualified Intermediary since 1992. That's when John Boyd, our CEO and CPA, began the business. John was a pioneer in the 1031 field. He's still with us, and he still provides some great insight and advisement for our clients working through some very, very complicated 1031s. We have Shauna Felkel, who is our in-house counsel. So we have a CPA. We also have an attorney in-house. Those are both important because we can talk to the clients and their advisors about how, okay, we're at point A, Dorian, and we want to get to point C. How do we do this and how do we do it most efficiently? We can step them through that process. We have a full host of exchange coordinators, probably the best customer service that I've ever experienced in working with clients, because you have to be responsive. There's timelines, there's dates, and there's a lot of money on the line for these clients. And so they like to have a responsive, whether that be by call, email, or whatever else. They want to know that they're being heard and that their every need is being taken care of. And so I can promise you that is what we do out of Greenville. As far as getting in touch with me, Dorian, the best way is my cell phone. And I'm glad to give that out. And that's 336-813-4157. You can call me, text me anytime, whether it's just a general question or a need for the business side, that's perfectly fine. But I'm willing to talk with anybody at any time about anything concerning a 1031, as long as I can be of best help to them. Our website is www.bankers1031.com, and my email is matt.linville@bankers1031.com. Feel free to reach out anytime.
Thanks again for being a part of the Real Estate Wealth Generator podcast. I look forward to having you on again. 1031s can go deeper. Situations are way more complicated sometimes. So I'd love to go into some of those other things in another episode. But thanks for your time, Matt, and look forward to connecting with you soon.
Thank you, Dorian. Thank you so much.
And if you want to get a hold of me, you can reach out to me. I have a commercial real estate coaching course that I teach on commercial real estate investing. You can reach out to me at workwithdorian.com. Of course, you can find me on all social media. I'm out there on everything, even TikTok now. Man, I tell you, my kids got me doing TikTok videos. So if you see some out there, you know, it's me. But I want to bring some fun and light to commercial real estate investment. Again, Real Estate Wealth Generator podcast. I can be reached at workwithdorian.com. Thanks, folks, and we'll see you on the next episode.